Good day, everyone. My name is Denise, and here are my group mates Maria, Patricia, Ira, Kate, and Dania from Group CT06. Today, we will present our critical analysis of SolarTech's financial and operational sustainability in the wake of significant ESG challenges. In the next 10 to 15 minutes, we will present key insights including financial viability, like break-even and CVP analysis, cash budgeting and compliance challenges, and ethical reflections. Before moving on, here's a brief introduction to SolarTech. They're a medium-sized Malaysian company based in Penang, specializing in the photovoltaic industry where they manufacture photovoltaic components, which are essential parts of a solar power system that converts sunlight into electricity. Over the last 2 years, they have seen average annual revenues of more than $25 million, making themselves one of the larger growing suppliers in the renewable energy solar. I will now hand it over to my group mates Maria and Patricia to discuss the company's financial viability.
Hi, everyone. I'll be explaining financial viability in our SolarTech component analysis. Okay, my part focuses on how the company break-even point and profitability change after adopting ESG compliance and what the cost volume profit figures tells about the risk and performance. Here is the given data. Before ESG, SolarTech sold 2 million units at 15 ringgit each with a variable cost of 10 ringgit. That gives a contribution of 5 ringgit per unit and a contribution margin ratio of 33%. With fixed cost of 7 million, the company break-even point was 1.4 million units, leaving a healthy margin of safety of 30%. At this level, the business earned about 3 million profit, showing a comfortable buffer and a low financial risk. Once the ESG plan was introduced, fixed costs rose by 2 million, mainly from solar installation and inclusion programs. This pushed the break-even point up to 1.8 million units. Although the sales volume stayed at 2 million units, the profit dropped to 1 million. And the margin safety narrowed to 10%. The degree of operating leverage jumped to 10 times, meaning a 1% change in sales could now change profit by about 10%. So SolarTech remains viable, but it's operating much closer to the break-even line. So is current sales adequate? To check if current sales are enough, selling 2 million units still covers the new 1.8 million break-even requirement. The profit calculation is simple. 5 ringgit contribution per unit times 2 million units equal 10 million ringgit contribution. After deducting the 9 million fixed cost, we get a profit of 1 million. That small margin shows the company is barely above break-even. Any dip in demand could quickly eliminate its profit. Here we can see the trend clearly. Before ESG, profit was 3 million with margin of safety of 30% and a leverage of 3.3 times. After ESG, profit fell from 1 million margin safety to 10% and leverage spiked to 10 times. So profit dropped by 2 million and the business became 3 times more volatile to sales changes. To summarize, the trend from 2024 to 2025, break-even rose by 29% from 1.4 to 1.8 million units. Profit declined by 2/3 from 3 to 1 million, and earning became much more sensitive to sales fluctuations. SolarTech is still profitable, but its financial cushion is thin. This sets the stage for the next part of our analysis. Now I'm going to pass it on to Maria.
For scenario A, SolarTech increases the selling price by 0.4 ringgit per unit. The new contribution per unit becomes 5.4 ringgit, giving a total profit of 1.8 million ringgit after costs. This shows an 80% increase in profit and also reduces the break-even point slightly. In scenario B, sales volume increased by 12% with no price change. This results in a profit of 2.2 million ringgit, a 120% increase compared to the baseline. However, this assumes SolarTech can increase both sales and production without raising costs. Based on the results, scenario B offers higher profits of 2.2 million ringgit compared to 1.8 million ringgit in scenario A. However, scenario A is less risky and mainly depends on how customers respond to the increase in price. Overall, scenario B is financially better if SolarTech can handle the extra demand, while scenario A is easier to implement. For the financial risks, in scenario A, higher prices may cause a drop in sales volume. Competitors could maintain their prices and make SolarTech less competitive, and delayed payments might increase bad debts. In scenario B, rising production costs could reduce profits if the 12% sales target isn't met, and higher outputs might push variable costs above to 22 million ringgit. For the non-financial risks, in scenario A, customer satisfaction may fall due to the rise in price, which could harm Solartech's brand image. In scenario B, rapid expansion may affect product quality, create environmental strain, and put pressure on employees and supply chains. Thank you.
My focus today is our cash position through 2027. The bottom line is this: we face a significant but short-term cash shortage. Our budget projects a challenging 2025, a clear turning point in 2026, and a return to strength by 2027. Let's walk through the specific budget numbers that define our next 3 years. In 2025, it's our investment trough. The math is stark. We start with a healthy 4 million ringgit from 2024. The cash receipts dropped to 19 million ringgit, but the critical hit is to outflows. Operating payments surged to 22.4 million ringgit, plus a one-time 2 million ringgit for compliance costs. The result is a net cash flow of negative 5.4 million ringgit. This leaves us with a projected year-end cash shortfall of 1.4 million ringgit. This deficit is the direct non-negotiable cost of our strategic pivot. In the year 2026, it is our financial inflection point. We start the year in a deficit of 1.4 million ringgit. However, our operational story changes completely. Receipts recover to nearly 20 million ringgit. Crucially, operating payments fall to 19.2 million ringgit as the massive upfront costs are behind this. This generates a positive net cash flow of 750,000 ringgit for the year. We are still in a deficit overall, but we are now cash flow positive. The engine is starting again. We see this in year 2027, where our strategy pays off on the balance sheet. We start at a reduced deficit of 650,000 ringgit. Our receipts jump 7% to over 21.3 million ringgit, reflecting new contract wins. Operating payments see a controlled increase to 20.16 million. This creates a strong net cash flow of nearly 1.2 million ringgit for the year. The result, we crossed the finish line with a positive closing balance of 500,000 ringgit. The transition is complete and our financial foundation restored. Now let's clearly identify our cash positions for each year, moving directly from the budget numbers. In 2025, we project a definitive cash deficit. Our closing cash balance is a negative 1.4 million ringgit. This qualifies as a severe cash shortfall, driven entirely by substantial upfront investments required for our ESG transition. In 2026, we remain in a deficit position, but it is a shrinking one. The closing balance improves to negative 650,000. The key takeaway here is not the remaining deficit, but the powerful shift to positive operational cash flow that has begun to reverse our negative trend. In 2027, we successfully returned to a cash surplus. The budget shows a closing cash balance of positive 500,000 ringgit. This marks the completion of the most challenging phase, demonstrating that our strategy not only stops the cash drain, but builds a new stable foundation for growth. In summary, the journey is clear: a deep but necessary deficit in 2025, a rapid recovery leading to a reduced deficit in 2026, and a confirmed return to surplus by 2027.
Now let's look at the key cash flow challenges Solartech is facing. First, high initial ESG costs in 2025. We're investing roughly 2 million ringgit upfront, including 1.4 million ringgit for installing rooftop solar panels and new energy systems, and 0.6 million ringgit to establish our diversity and inclusion program. This places significant pressure on short-term liquidity. Second, a delayed payoff period. The financial benefits from improved efficiency and brand recovery will only appear gradually starting in 2026. That means 2025 may require external financing or temporary debt to bridge the gap. Third, uncertain revenue recovery. Our cash inflows depend heavily on how the market responds to Solartech's renewed ESG image. If reputation recovery is slower than expected, our 2026 receipts might fall short, causing strain on working capital. Fourth, operating cost pressure. The new D&I initiatives bring recurring costs such as training, mentorship, and regular audits. In addition, maintaining solar systems and upgraded facilities will slightly increase fixed costs beyond 2027. And lastly, liquidity management risk. With already thin margins, any delay in receivables or unexpected cost overrun could worsen the 2025 deficit. This means we'll need proactive cash reserve planning or short-term credit lines to ensure smooth operations. Now for the compliance management challenges and how we plan to mitigate them. ESG investment versus profitability. The high upfront ESG spending will reduce our short-term profit margins. To manage this, we'll phase investments gradually and explore green financing schemes such as government ESG grants. Operational disruptions. Upgrades and installations may temporarily disrupt production. Our mitigation plan is to schedule works during off-peak months and build buffer stock to maintain delivery timelines. Next, D&I implementation and costs. Ongoing training and policy enforcement will require a sustained HR budget. We'll monitor the impact annually and adjust spending based on measurable outcomes. Next, stakeholder pressure. Investors may be concerned about reduced profits, while employees expect rapid cultural change. To address this, we'll ensure transparent communication through annual sustainability reports that highlight long-term ESG benefits. Lastly, regulatory uncertainty. Future carbon or ESG-related policies could introduce new compliance costs. Our approach is to maintain flexibility and allocate contingency funds for any unforeseen changes. In summary, 2025 will be a testing year for SolarTech's financial endurance. However, with careful planning, phased investments, and strong communication, the company can navigate the short-term strain and position itself for a more sustainable and resilient future from 2026 onwards. Thank you.
Beginning the last part of our presentation, I would like to discuss the ESG challenges faced by SolarTech, including its high carbon emissions and lack of workplace diversity and inclusivity. First, the high carbon emissions are caused by heavy reliance on electricity from the Malaysian grid, which is still highly coal-dominated. This results in high amounts of emissions per unit of output, making it the highest in its sector. The primary consequence faced is the threat to SolarTech's business viability, caused by increasing concerns from international clients, who warn that the company may lose contracts if it fails to adopt greener practices. Failure to act towards greener practices threatens the company's ability to maintain its competitiveness in the renewable energy sector, directly impacting their revenue and market share value. Second, the company has also faced criticism for its lack of employee diversity and inclusivity, D&I, particularly in terms of female and minority representation, especially in senior roles. For example, fewer than 15% or 38 of the company's 250 employees are women, with senior management roles being held almost exclusively by men. Reports have also cited biased hiring and limited career progression for both women and minorities. For example, favoring male applicants over qualified women in hiring and interview processes. This has attracted negative publicity towards the company, implying that they have a non-inclusive environment, limiting talent development for a significant portion of the workforce. This D&I issue has contributed to overall scrutiny, threatening the company's ability to maintain existing contracts and attract new business opportunities from ethically conscious partners.
Now moving on to the risks if SolarTech chooses to prioritize short-term profits over ESG reforms. Avoiding ESG investment may appear beneficial in the short run as it reduces immediate costs. However, this approach exposes the company to significant long-term risks. If SolarTech continues to operate with high carbon emissions, it may lose the confidence of international clients who increasingly require suppliers to demonstrate sustainability commitments. This could result in contract cancellations, reduced export sales, and reputational damage, ultimately weakening SolarTech's competitiveness in the renewable energy sector. Similarly, choosing not to address the workplace diversity and inclusivity concerns can harm the company's internal environment. Employees today value fairness and equal opportunities. A non-inclusive culture may lead to high employee turnover, lower morale, and reduced innovation, limiting SolarTech's organizational performance over time. Therefore, although delaying ESG reforms may temporarily preserve profits, the long-term consequences such as loss of clients, negative public perception, and reduced workforce effectiveness could result in greater financial harm. Prioritizing short-term gains over ethical responsibility is not sustainable for the company's long-term success. Next, to balance financial recovery with ESG obligations, SolarTech should integrate sustainability into its broader business strategy. A practical approach would be to implement environmental upgrades in phases. Gradually installing rooftop solar panels and energy-efficient machinery allows the company to manage cash flow while reducing emissions. SolarTech may also seek external support, such as government sustainability incentives or green financing, to ease the financial burden of these upgrades. On the social side, strengthening inclusivity can be achieved by establishing clear recruitment targets, mentorship programs, and transparent promotion pathways for underrepresented groups. Finally, regularly reporting ESG progress rebuilds trusts with the stakeholders and reinforces SolarTech's commitment to responsible business practices. By aligning financial objectives with ethical responsibility, SolarTech can maintain competitiveness while positioning itself as a sustainable and credible industry leader. Thank you for your time.